Have you looked at your rent bill lately and just felt a knot in your stomach? You are definitely not alone. There's this massive, incredibly frustrating gap growing right now. On one side, your rent is absolutely skyrocketing. But on the other side, your paycheck is sitting completely still. We literally feel this every single month. But here's the thing. Most explanations for why this is happening totally miss the real cause. So let's dive into this explainer and figure out what's really going on.
Usually, when you ask why housing has gotten so insanely expensive, you get the exact same answer. People say, well, we just need to build more houses, right? It sounds so simple. Good old supply and demand. But honestly, that standard explanation completely misses the real hidden mechanisms driving today's affordability crisis.
Section 1, supply versus demand, isn't the full story.
We hear all the time that cities just don't have enough homes. But why does that fail to explain the massive scale of our rent problem? Well, look at Auckland, New Zealand. The city actually implemented major zoning reforms to allow for way more construction, and during recent years, they even saw their population decrease. So demand went down and the ability to supply went up. You'd expect rents to absolutely plummet, right? But they didn't. Rents remained incredibly sticky. They rarely went down at all. Why? Because the market just doesn't act like a simple textbook equation anymore.
Now, people also love to point the finger at short-term rentals. They say vacationers are snapping up all the apartments. But let's look at the actual data. Sure, short-term rentals do drive up prices in very specific, tourist-heavy neighborhoods. But broad, national studies show absolutely no detectable association between short-term rentals and overall housing costs. They simply do not explain the massive, widespread scale of rent hikes across everyday cities.
Section 2, the investor factor.
So if it isn't just a lack of supply, and it isn't just vacation rentals, what on earth is it? Well, we're seeing large investment firms buying up residential properties at an unprecedented scale, and they deliberately target specific neighborhoods. They're looking for areas with lower housing values, which often have a higher share of working-class residents. Then they swoop in and buy up single-family homes at a massive scale. This fundamentally changes the local fabric. You aren't just competing against another family for a home anymore. No, you're competing against a multi-billion-dollar fund.
And the sheer aggression of their pricing. It is shocking. When institutional investors acquire a property, they raise rents at a 60% higher rate than your average landlord. Literally 60%. And it gets worse. Having a mega investor in your neighborhood actually causes regular non-investor landlords to start raising their rents faster too. It spreads like wildfire.
So how do these massive corporations know exactly how high they can push your rent? 2 words: algorithmic pricing. This is specialized software used by property management companies to squeeze out maximum revenue. Basically, the algorithm tells thousands of landlords in the exact same city exactly what to charge. It essentially coordinates market-wide rent hikes. And honestly, the craziest part? The software actually encourages corporate landlords to keep prices artificially high, even if it means leaving apartment units sitting completely empty. Thankfully, this kind of market behavior isn't going completely unnoticed. Right now, this software is facing intense regulatory scrutiny and massive class action lawsuits. Even the Department of Justice is investigating. Renters are alleging that this pricing software is directly responsible for pushing prices well above normal competitive levels, because at this point, it acts way less like a free market and a lot more like a monopoly. So what is the actual impact on your wallet? Studies show that markets fully penetrated by this algorithmic pricing software see average rents up to 3% higher than markets without it. Now, 3% might not sound huge at first glance, but across an entire city, that costs renters billions of dollars, and it hits you regardless of how much you earn. Section 3, the wage stagnation side. Okay, so we've talked about why rent is artificially high, but why hasn't our income kept pace? Data tracking living conditions reveals a really tough truth. The bottom income brackets are consistently losing ground. They're falling further and further behind compared to the median household. You know, economic growth used to mean everyone's living conditions improved. But now, real wages for many working people have just flatlined, while the costs of basic necessities keep marching upward. A major reason for all this financial pain is the commodification of housing. Housing has completely transformed. It's no longer viewed primarily as a basic human need or shelter. Instead, it's now a financial vehicle designed to maximize yield for investors. This creates a severe cost overburden and erodes your wealth and severely squeezes your ability to pay for other absolute basics, like food and healthcare. If you're finding this valuable, please subscribe to Wealth Lab and share this explainer with your friends and family. It really helps us grow. Section 4. What this means for renters. I know it's incredibly easy to feel helpless right now, but there are practical ways to protect yourself financially in a market where rent is constantly outpacing income growth. Let's look at some actionable, practical survival tactics. First, spot the red flags of algorithmic pricing. If a property manager flat out refuses to negotiate rent, points to a computer screen for their daily pricing, and doesn't seem to care at all if the unit stays vacant, you're probably dealing with the algorithm. Second, check your local short-term rental laws, just so you understand your specific market. But third, and most importantly, seek out single-unit mom-and-pop landlords. And why is that so important? Because of what researchers call the vacancy-loathing landlord. You see, independent, single-unit landlords absolutely loathe vacancies. A massive corporation can totally afford to let 10 units sit empty just to keep their prices high. But a mom-and-pop landlord, they simply cannot. The data shows they will often offer an identical, unhiked contract just to preempt a good, reliable tenant from searching elsewhere. Finding these landlords is absolutely your best financial defense right now. So the question is, how will you adapt your search to outsmart the algorithm in today's housing market? Thank you for joining us today. If you haven't already, don't forget to subscribe to Wealth Lab. We'll see you in the next one.